Hello, this is Edmund Shing of BCS Asset Management. Today we're going to look at global fund flows and draw some conclusions. We're going to look at US household flows, we're going to look at European fund flows, and finally look at exchange traded fund flows. If we start with US household funds, we can see that US household wealth has grown by some $75 billion over the last year. And today, 24% of total net household wealth sits in direct holdings of equities and also equity mutual funds. Note, however, that US households still have 12% sitting in cash, which is still quite a lot on the sidelines. If we look here on page 4 at how this has developed, we can see that the gain in the wealth effect has been largely driven firstly by the rising stock market, over here where it says direct equity holdings, and secondly over here where it says real estate equity. So those are the two big drivers, and of course coming into the last quarter of the year they continue to move up, generating yet more wealth for US households, and that's good news for the US economy. If we look here at the mapping of global mutual funds, we can see that over 80% of total assets in global mutual funds are still held in Europe and the US, so they still dominate the global scene for funds. Here in the US, we can see that US mutual fund flows have been in favour of equities, that is these blue bars here, and out of the green bars, which are bond funds. So there's been heavy selling of bond funds and some buying of equity funds over the last few months in the US. However, this is only a small part of a reversal from the huge inflows to bonds that we've seen over the last 5 years since 2008. So it could go quite a lot further. Again, in terms of equity fund flows, what have American investors been favouring? They've been favouring world equity, that is these dark green bars, rather than these light blue bars, which is domestic equity. So they've been buying Europe for value and also Japan, given the strong growth in the Japanese stock market. Now, if we turn to Europe, we can see that European fund flows have not been as favourable to equities. In fact, only the last couple of months have we seen outflows from bond funds and inflows to equity funds. Just like the US, we saw a big inflow over the last few years into bonds, but in the case of Europe this has been largely out of cash, out of money market funds and into bond funds. So staying safe but trying to pick up some extra yield. Now, the UK is an exception to this. We can see here these dark blue bars are UK retail investors buying equities heavily for the last 7 months. This is mirrored by what we see in exchange traded fund flows globally. If we look to this dark red line here, we can see that there's been $280 billion of inflows to equity ETFs this year, and that includes US and Europe. And that's stronger than the previous 3 years. Within that though, we can see that in foreign equity funds, actually Japan, the orange line, has been very popular and has been more popular in the year to date than European equities. So I think there's still some catch up there for Europe to come. Emerging markets have been out of favour. You can see from this dark blue line down here, people have been net sellers of emerging market equity funds this year, given the relatively poor performance when you look at Europe or the US. So to sum up, US households are getting richer thanks to the wealth effect from housing and from the stock market. Investors in the US have started buying equity funds and in the UK as well, and have been selling some bond funds, but this is only small beer and could go a lot further given the massive rush we saw into bond funds between 2008 and 2012. So for me, this remains relatively positive medium-term outlook for the equity market. This is Edmund Shing from BCS Asset Management saying goodbye.